In the intricate tapestry of international trade, the ongoing tariff war between the United States and China has escalated to dramatic heights with ramifications that could reshape global economic dynamics. As President Donald Trump imposes staggering tariffs on Chinese imports, now reaching as high as 245%, the Chinese government is grappling with both immediate retaliation and the long-term implications for its economy and political landscape. In early April 2025, Trump's administration announced a sweeping increase in tariffs, first setting a minimum rate of 54% and then rapidly escalating it to over 100%. This aggressive stance has led to reciprocal measures from Beijing, which has imposed similar tariffs on American goods, igniting fears of a protracted trade conflict. Amid this tumult, economic analysts and experts are weighing the potential fallout, with many expressing concern over the stability of both nations' economies. During a recent discussion with Yaxing Huang, an economist from MIT Sloan School of Management, the nuances of China's response to these tariffs were explored. Huang emphasized that while the Chinese Communist Party (CCP) does not desire a full-blown trade war, it is wary of appearing weak. They don't want to cave in. That would make the leadership look very bad, he noted, indicating a complex balancing act between maintaining power and addressing economic vulnerabilities. China's economic landscape is fraught with challenges, including a significant reliance on exports, which account for nearly a third of its GDP. Recent data shows that approximately 20% of this export volume is directed toward the United States. With millions of jobs tied to these exports, the stakes are high for Beijing. Despite ambitions to pivot toward domestic consumption, Huang pointed out that consumer confidence remains fragile, exacerbated by a struggling property market and high youth unemployment rates. As the trade war intensifies, the immediate impact has reverberated through global markets. The price of gold has surged, hitting a record high of $3,357.40 per ounce as investors flock to safe haven assets amid fears of economic instability. Federal Reserve Chair Jerome Powell warned that the newly imposed tariffs could lead to slower growth, higher inflation, and rising unemployment in the U.S. The dollar is stumbling under the weight of trade policy whiplash, noted Stephen Innes from SPI Asset Management, highlighting the broader implications for global financial stability. Moreover, the psychological and political dimensions of this trade conflict cannot be underestimated. Trump's administration has maintained a hardline stance, asserting that the onus is on China to return to the negotiating table. The ball is in China's court, Trump stated, reinforcing a narrative that both sides are entrenched in a game of economic brinkmanship. Conversely, Beijing has emphasized its resolve, asserting through state media that it will endure hardship rather than capitulate to U.S. demands. In a surprising development, the Hong Kong General Chamber of Commerce announced the postponement of a scheduled trip to the United States in light of the deteriorating geopolitical climate. Patrick Young, the Chamber's CEO, cited the fast-changing situation and the recent rhetoric from Chinese officials as significant factors in their decision, underscoring the chilling effect that the trade war has on bilateral relations. Looking forward, analysts express concern that the CCP's grip on power is contingent upon economic performance. A protracted trade war that leads to increased unemployment and declining living standards could provoke unrest, an outcome the leadership is keen to avoid. Huang articulated that the CCP faces a dilemma. To enhance domestic consumption and social welfare, it may need to relinquish some control, an option that could threaten its political stability. As the dust settles on the latest rounds of tariff announcements, the question remains, which nation will blink first? With the economic pressures mounting on both sides, the stakes could not be higher. While Trump's administration seems to believe that China has more to lose, the intricacies of the Chinese economy, characterized by its dependence on exports and fragile domestic demand, suggest a precarious situation that could lead to unforeseen consequences for both global markets and political landscapes. Only time will reveal the ultimate outcome of this high-stakes trade war, but the path forward is fraught with uncertainty and potential instability. The escalating trade war between the United States and China has emerged as a pivotal issue with the potential to dramatically reshape not only the American economy but also the global economic landscape. As President Donald Trump intensifies his tariff policies, experts are increasingly warning of the profound risks associated with a prolonged economic standoff between these two superpowers. Economists contend that the stakes are exceptionally high. Jason Furman, a professor at Harvard Kennedy School and former chair of President Obama's Council of Economic Advisors, cautions that the trade war could fundamentally undermine the very fabric of American influence on the global stage. There is a good chance that this is something that isn't just printed in the newspapers today but is in history books decades from now, Furman remarked, emphasizing the potential for a significant shift in the balance of global power. At the heart of the trade dispute is the administration's aim to revitalize U.S. manufacturing, a cornerstone of Trump's America First agenda. Trump has consistently pledged that jobs and factories will return to American soil. However, this vision is met with skepticism from many economists who question whether tariffs, particularly the chaotic and frequently changing nature of Trump's tariffs, will actually lead to increased domestic production or job creation. The U.S. is exporting a lot of high-value services, software, Hollywood, banking, that's where the future lies, noted Jayant Menon, a senior fellow at the ISAS Yusof Ishak Institute in Singapore. Menon warned that the trade tensions risk jeopardizing the U.S.'s future as a high-tech hub. As the trade war escalates, the implications for American consumers are becoming increasingly tangible. Tariffs on a wide range of goods from aluminum foil to textiles are likely to raise prices for everyday items. The lower your income is, the more reliant you are on imported goods from abroad, Furman explained, indicating that the burden of tariffs will be disproportionately felt by lower-income households. Reports indicate that tariffs could lead to an average decline of nearly $4,700 in disposable income for American households, with low-income families facing the steepest relative losses. The trade war is also taking its toll on U.S. farmers, particularly soybean farmers, who are bracing for significant losses amid retaliatory tariffs from China. As the U.S. imposes tariffs as high as 145% on Chinese imports, many farmers fear that their livelihoods are at stake, especially as Brazil capitalizes on the trade war by increasing its soybean exports to China. The uncertain and volatile nature of Trump's tariff policies is causing significant disruptions in supply chains. American manufacturers that depend on imported parts from China face rising production costs, which could diminish their competitiveness in global markets. Stan Vuger, a senior fellow at the American Enterprise Institute, noted that many businesses may hesitate to invest in the U.S. due to the risks associated with relying on international supply chains. If you want to build a factory in the U.S. that relies on parts that come from Mexico or from China, that's less attractive, he said. As the situation evolves, the potential for a decoupling of the U.S. and Chinese economies looms large. Both nations together account for approximately 43% of the global economy, and a significant reduction in trade could lead to duplicate supply chains emerging, one centered around the U.S. and another around China. At some point, a 100% or 200% tariff, the actual number no longer matters because it's basically meaningless to do trade, Liu stated, highlighting the futility of escalating tariffs while both economies remain deeply intertwined. In the face of these challenges, some experts hold a more optimistic view, suggesting that a resolution to the trade tensions is still possible. Liu indicated that China's recent openness to trade negotiations, albeit under specific conditions, could pave the way for a more stable economic relationship. However, the path forward remains fraught with uncertainty, particularly as both nations grapple with the repercussions of their respective trade policies. As businesses and consumers navigate the complexities of the ongoing trade war, the long-term effects on both economies and their global standing remain to be seen. Economists agree that at least in the short term, neither side stands to gain significantly from continued escalation. At the end of the day, there is no clear winner, Zhang noted, adding that both economies could suffer substantial disruptions. In conclusion, the U.S. China trade war is not merely an economic skirmish but a critical juncture that has the potential to redefine international relations and economic power structures for years to come. As both nations continue to assert their positions, the global community watches closely, anticipating how this intricate dance of tariffs and negotiations will unfold in the coming months. The implications for global trade, economic growth, and international alliances could be profound, and the world stands on the precipice of change driven by these two superpowers. As the geopolitical landscape shifts dramatically with Donald Trump's return to the White House, nations across the Asia-Pacific region are grappling with newfound uncertainties regarding their security and diplomatic alliances. Trump's administration has already disrupted long-standing global norms, igniting a wave of defense spending and diplomatic maneuvering among countries increasingly wary of both U.S. intentions and China's assertiveness. In recent weeks, Trump's controversial statements and policies have compelled East Asian countries to recalibrate their strategic postures. His apparent alignment with Russia over the Ukraine conflict and the imposition of punitive tariffs on allies raise questions about the reliability of U.S. support in a region fraught with tensions. The Taiwan Strait, a vital shipping lane, remains a focal point of anxiety, as China continues to intimidate Taiwan while also sparking territorial disputes with Southeast Asian nations and Japan. Australia exemplifies the region's response, announcing its most significant defense budget increase since World War II. However, the Australian government has yet to meet Trump's expectations for NATO allies, which call for spending at least 3.5% of GDP on defense, a figure that would require an additional 36 billion Australian dollars, approximately $25 billion. Currently, Australia's defence spending sits at 2% of GDP, with projections indicating a gradual rise to 2.4% by 2027-28. The focus remains on enhancing long-range deterrent capabilities, particularly through submarine and missile defence systems that aim to bolster Australia's strategic position in the Indo-Pacific. Meanwhile, China has seized the opportunity presented by U.S. tariff policies, which complicate the economic landscape for its neighbors. U.S. Defense Secretary Pete Hegseth's recent tour of Asia, emphasizing a shift toward the Indo-Pacific in response to Chinese aggression, was overshadowed by the announcement of tariffs ranging from 17% to 24% on imports from key allies like the Philippines and Japan. Such policies threaten to alienate these nations, potentially pushing them closer to China, which continues to ramp up its military spending by over 7% this year. For Taiwan, the stakes are even higher. President Lai Ching-te's administration is under pressure to significantly increase defense spending, a daunting task given that Trump has suggested Taiwan should contribute more to its own defense, potentially raising expenditures to 10% of GDP. With the current defense budget hovering below 3%, such an increase would be nearly impossible without crippling Taiwan's economy. Nevertheless, Lai has committed to boosting defense spending to over 3% as part of a broader strategy to enhance Taiwan's resilience against Chinese military threats. The Philippines, under President Ferdinand Marcos Jr., has adopted a tougher stance against China, moving closer to the U.S. The Mutual Defense Treaty between the two nations has been revitalized, allowing increased U.S. military access to Philippine bases and enhanced intelligence sharing. The Philippines is earmarking $35 billion this year for military modernization efforts, reflecting a commitment to counter Chinese assertiveness in the South China Sea amid ongoing territorial disputes. Vietnam finds itself in a precarious position, attempting to balance its economic ties with both the U.S. and China. Following the imposition of a 46% tariff by the U.S., Vietnam is reportedly preparing to tighten controls on sensitive exports to China while increasing purchases of U.S. goods, particularly in the defense sector. As Vietnam continues to enhance its military capabilities, it remains wary of provoking China, particularly in the context of ongoing island-building activities in contested waters. Japan, echoing sentiments from its past, is ramping up its defense budget under increasing pressure from Washington. The current administration has pledged to double defense spending by 2027, aiming for 2% of GDP. Japan's defense minister recently acknowledged the need to bolster military capabilities amid calls from U.S. officials for Japan to shoulder more of the financial burden associated with the U.S. military presence. In South Korea, political instability adds another layer of complexity to international relations in the region. The impeachment of President Yoon Suk-yeol has left the country in a state of uncertainty regarding its commitments to U.S.-led regional security initiatives. With North Korea continuing its nuclear ambitions, there are growing discussions within South Korea about developing an independent nuclear deterrent. A significant shift in policy that reflects concerns over U.S. reliability under the current administration. As the Asia-Pacific nations navigate this tumultuous period, the regional dynamics will likely continue to evolve in response to both U.S. and Chinese strategies. The outcome of these geopolitical shifts remains uncertain, but one thing is clear: the stakes are higher than ever and the potential for conflict looms large as nations reassess their alliances and defense postures in the face of emerging threats. The coming months will be crucial in determining how these nations adapt to a rapidly changing global landscape and whether they can find a cohesive strategy to address the myriad challenges ahead.